Welcome back to Financial Market Insights for Traders, the podcast that helps you decode market trends, fine tune your trading strategies, and make more informed decisions. I'm Sophia, and today we're diving into one of the most powerful but often misunderstood aspects of trading: market sentiment analysis. Whether you're an experienced trader or just starting out, understanding market sentiment is key to staying ahead of price movements and positioning yourself strategically in any market. Markets are emotional creatures. They rise on optimism and fall on fear. And right now, in 2025, with interest rate shifts, geopolitical instability, inflation concerns, and renewed retail trading interest shaking up financial markets, market sentiment is more important than ever. So today we'll break down what market sentiment really is, how to measure it, and most importantly, how to use it to make better trading decisions. If you want to learn how to read the market like a pro, anticipate trends before they happen, and avoid getting caught on the wrong side of a trade, this episode is for you. What is market sentiment? Market sentiment refers to the overall attitude of traders and investors toward a particular asset, market, or economy. It is shaped by everything from economic data and corporate earnings reports to geopolitical events and social media discussions. Broadly speaking, sentiment falls into two categories. Bullish sentiment: investors and traders are optimistic, expecting prices to rise. Bearish sentiment: investors and traders are pessimistic, expecting prices to fall. In today's volatile trading environment, sentiment is arguably just as important as fundamentals and technicals. A strong earnings report means little if the market sentiment is overwhelmingly bearish. A struggling company can still see stock price surges if sentiment turns euphoric. Just look at the recent short squeezes and meme stock rallies driven by retail traders. Why market sentiment matters in 2025. Right now, market sentiment is at an inflection point. With the Federal Reserve hinting at potential rate cuts, inflation cooling off in some regions but remaining a concern in others, and ongoing global conflicts impacting supply chains, sentiment is driving extreme volatility across equities, Forex, and crypto markets. Take Bitcoin, for example. Earlier this year, BTC surged past $75,000 on the back of institutional adoption and renewed interest in crypto ETFs. But just as quickly, a market correction followed as sentiment turned cautious due to regulatory crackdowns in Asia and uncertainty around central bank policies. In Forex markets, we've seen wild swings in emerging market currencies as traders assess how economic slowdowns in China and shifting trade policies in the US will impact global demand. And in equities, the divide between institutional investors and retail traders is growing, with hedge funds focusing on macro risks while individual traders continue to chase momentum plays, meme stocks, and AI-driven trends. This is why traders must understand how to measure sentiment and use it effectively. How to measure market sentiment. Market sentiment isn't just a feeling, it's quantifiable. And professional traders use a combination of sentiment indicators, news analysis, and price action signals to gauge whether the market is leaning bullish, bearish, or neutral. 1. Sentiment indicators. Sentiment indicators provide real-time insight into investor behavior and market mood. Some of the most widely used include Fear and Greed Index, a multi-factor indicator that tracks volatility, momentum, and demand to determine if the market is overly greedy, a potential sell signal, or fearful, a potential buy signal. Commitment of Traders COT report, published by the CFTC. This report reveals the positioning of large institutional traders versus retail traders, offering clues on market direction. Put/call ratio. A high put/call ratio suggests bearish sentiment as more traders are buying protective puts, while a low ratio signals bullish sentiment. Volatility Index VIX, often called the fear gauge. The VIX measures expected market volatility. Higher VIX readings indicate rising fear and uncertainty. Short interest ratio. If a stock or index has high short interest, it could mean investors are extremely bearish or that a short squeeze is brewing. 2. News and social media sentiment analysis. In 2025, social media and digital news platforms play an even bigger role in shaping sentiment than ever before. AI-powered tools now scan breaking news headlines and their potential market impact. Market-moving tweets from influential investors and CEOs. Discussions on financial forums like Reddit and Twitter. Crypto sentiment on platforms like X and Telegram. Retail traders have significantly more influence than they did even 5 years ago. Just look at how crowd-driven trading movements continue to shake up markets, from meme stocks to flash rallies in undervalued assets. 3. Technical indicators for sentiment confirmation. While sentiment analysis is often thought of as a fundamental approach, technical indicators can help confirm or challenge sentiment-driven moves. Moving averages, a rising 50-day or 200-day moving average signals bullish sentiment, while a falling average indicates bearishness. Relative Strength Index RSI. RSI above 70 suggests an asset is overbought, potentially signaling excessive bullish sentiment. RSI below 30 indicates an asset is oversold, meaning sentiment could be overly bearish. Volume analysis. Heavy buying volume on a rally suggests strong bullish sentiment, while high volume on a sell-off confirms bearish conviction. How to use market sentiment in your trading strategy. 1. Trend identification. Market sentiment helps traders spot trends early and avoid trading against the prevailing direction. If sentiment is bullish, prices are more likely to rise, and vice versa. 2. Contrarian trading strategies. Contrarians use sentiment to trade against the crowd. When markets are in extreme fear mode, contrarians buy undervalued assets. When markets are in euphoric greed mode, contrarians sell overbought assets. 3. Risk management and volatility assessment. During times of high fear, markets become more volatile. Smart traders adjust their strategies by reducing leverage, using stop-loss orders to protect capital, scaling into positions rather than going all in. 4. Sentiment-based trade execution. Momentum trading, buy assets with strong bullish sentiment and ride the trend. Breakout trading. Look for high sentiment confirmation before entering breakout trades. Market neutral strategies. Hedge exposure when sentiment is uncertain or conflicting. Final thoughts. Market sentiment is one of the most powerful tools a trader can use. It provides insight into crowd psychology, risk appetite, and potential trend reversals. As we navigate 2025's fast-moving financial markets, understanding sentiment is more important than ever. By using sentiment indicators, news analysis, and technical confirmations, traders can position themselves for smarter, more strategic trades. For trading tools and resources, visit crystalballmarkets.com. That's it for today's episode. If you enjoyed this discussion, subscribe, leave a review, and share this podcast with fellow traders. Until next time, stay informed, trade smart, and always be aware of the market's pulse.